cheap rate means they are getting market share, and then based on this market they are getting consumers who are paying them heavy price. Like, at least you see you are getting something is better than nothing. And today you see they have huge surplus foreign exchange reserves with them. Now you see, when they have surplus, they can invest in foreign countries. India, China don't have good border relation, so they do a border dispute. So you see, India is losing on this front. You see, it's better in one way or other. You because why? Because you see, China is a very aggressive country. Now we are shifting from our basic concept. Hence, let's come back to our topic. Now you see, introduction to capital flight. Capital flight is like when funds are sent out of India. Now you see, India is a developing nation. Imagine, how do you feel if Indian corporates, businessmen, they are taking Indian capital and they are investing in some African nations. They are no more interested to invest in India. Right now, I don't think so. This stage is there. But in future, let's say 5 to 10 years of time, you'll find this situation happening very frequently, where big business houses would not be interested in investing in India. Rather, they'll be shifting their bases from India to some other African nations or underdeveloping countries, where you see there is huge scope of development. There is huge scope of earning. Now you see, India is emerging right now. Hence, foreign countries and their investors are investing in good amount in India. FDI, foreign direct investment, or foreign institutional investors who are investing in share markets. You see, you take any of these two, you'll find India is getting investments from abroad. So when you are getting investments, means all your deficits or all your requirements can be accomplished very well. You need not to depend on anyone. So they are coming automatically. So you have capital surplus, and now you can entertain all your requirements. You can develop at a very fast rate. And you see, you right now you are into developing state. Maybe once you are developed fully, you can go and join the most developed nation group. Okay, like I'll name some of the developed countries like United States, you have Japan, you have Germany, you have Australia, Canada. They all are falling into this category, which is developed nation. So there you'll find people who have surplus, who are willing to invest in foreign countries. But in countries like Brazil, India, China, China to some extent can be taken out from this group. South Africa and your entire African subcontinent or your entire Asian subcontinent, you see there are countries which are struggling, and hence they need foreign investment badly. Like you see, Pakistan is badly struggling right now with foreign exchange reserves. They don't have much, so they are trying to borrow it from International Monetary Fund (IMF). So IMF is agency, international body whose main role is to stabilize currency valuations. Okay, and Pakistani currency, that rupiah, is depreciating like anything. So value is going down. Inflation is so high. You see, I'm actually a non-vegetarian. So if I look at 1 kg chicken cost in India, will be there somewhere around 200 rupee or 220 rupee per kg. But when you go across the border and you'll try to get chicken there, you'll be getting the same chicken for 600 rupees per kg. Only difference is like it is not Indian rupee, it is Pakistani rupee. Okay, so now problem is like when you have devaluation or you see your currency don't have any value. Now you see what it indicates, your country is struggling badly. So in a situation where your political stability is not there, economic crisis is going on, foreign investors would not like to come in. Okay, there is a concept of pestle analysis: political, environmental, social, technological, and then ecological and legal environment. So you see, if these factors are positive and is actually motivating investors to come in and invest in countries which are developing in nature. But if you have a rigid uh, framework or political instability or economic and legal laws which are very very constrained, restraining, they don't have they don't have any freedom element for the business houses. Now you see, these factors may avoid may compel or may restrict these foreign fund flows to local countries. Like right now, I tell you, BJP is there in power for last almost 10 years. Okay. Now you see, again, election is going on in India now. Now you see, in case this BJP is getting uh, substituted by the opposition party, which is India Alliance. Now you see what will happen when this new government is going to form. They are going to withdraw most of the reforms which has been brought by the previous government, and which will bring in instability. And this political changeover will have an adverse effect on your markets. Foreign investors may not be willing to come to India for some period of time because they are seeing an element of instability. So, do you see, changeover means instability. It may take time to again bring back your stability. So, you see, capital flight outward is all evident. But if you have again BJP coming back in power again in this election, what it means, investors will have a bull run. Share markets will again jump upwards. Share market is direct indication of what is investors sentiment. They'll see positivity all around. Same government, same policy, and will be extended further for next 5 years. Means lots of reforms are planned to be coming in. Okay, so this is how you see investors may have a call on whether to bring in capital inward or take it outward. So again, one more thing which is not right now coming into my mind related to this term called as capital flight. I'm sure that you must have heard about Indian economic crisis of 1990 when Prime Minister, you see, that time Prime Minister was Narasimha Rao and Finance Minister was Manmohan Singh. This is a very famous story in Indian history. Now you see that time India was struggling badly. It is in 1990s. There was Gulf War. Gulf War means war between Iraq and USA. Gulf zone is actually exporting crude oil. India is an importer, so India has to pay for crude oil. And if you see this crude oil is getting costlier due to this war cost, you see India don't have much of option. They have to pay for it. They have to pay for it. Okay, they have to. Let's say right now I'm buying crude oil for, let's say, $50 per barrel. After war, I may be required to pay $70 per barrel. This is going to be a heavy cost. I don't have much of choice. I have to use it. So it's bit problematic. I have to pay for it. I don't have much of choice. It may go to 60, it may go to 70, it may go to 80, it may go to 90. Because I'm a consumer, I don't have much choice. I have to pay for it. Now you see, imagine that time what happened. One is Gulf War started. India don't have heavy foreign exchange reserves with them. NRIs who were sending money in India, they started withdrawing it out of India. Why? Because you see capital movement outward. Now this is what I was trying to tell you. NRIs will return their investments back to their home country. But in 1990, there is an international credit rating agency called as Standard and Poor (S&P), who downgraded India in terms of investment opportunity. And hence, what happened is like there was a negative outlook for Indian investments. Hence, these NRIs started looking towards India negatively and they started withdrawing their funds out of India overnight. And it was a heavy movement of funds outside India. So, hence, what happened is like you see capital flight movement outwards created additional pressure on Indian foreign exchange reserve. India was very close to bankruptcy. We were left with only 1 week of foreign exchange and India started asking for help from foreign countries, especially from United Kingdom and Japan, because they are our old friends. You see, they ruled us for approximately 200 years, but no one was actually willing to help. You know, that time India exported, it is not an export actually, it was India gave 56 tons of gold, 56 tons. 1 ton is 1000 kg. So 56,000 kg of gold was given as a collateral, as a security to European banks and some of the Japanese banks so that they can lend us heavy foreign exchange and we can use it for running a country like India. That time population was less, no doubt, but still your requirements are very heavy. And if you don't do it, you will go into bankruptcy. Now you see there was a structural problem and you cannot improve it. So International Monetary Fund, World Bank, that time you see you don't have this concept of World Bank and World Trade Organization, but you have World Bank. And you are a founding member. India is a founding member of General Agreement of Trade and Tariff, GATT, GATT. Okay. Hence, you see, India was given advice to open up the market. We were a closed economy prior to 1990. After 1990, we opened up our market. And this concept is called as LPG. LPG stands for liberalization, privatization, and globalization. Okay. So after liberalizing means open your market, bring your rules down, give more freedom to foreign players. MNCs should be invited in. They should be given level playing field, any same treatment or preferential treatment as compared to local companies so that they should feel comfortable coming in India and bringing in capital along with them. Now, same is what is your situation in Pakistan today? They need foreign investments badly, and foreigners are not willing to come in due to law and order issue, due to political instability, due to like the economic conditions that are undergoing there. So you see, you need to have a reform like India, which we did it in 1990. So you have to do it in this now in Pakistan. Okay, so moving along with the same, now we were discussing some of the points related to capital flight inward or outward. uh, Sometimes it is also good, like capital flight outward is also good. Like you see, you remember Tata acquired a brand called as you see, Tata Chorus. There is a like you see foreign iron ore company which Tata company acquired. So in order to have your global operations, you need to invest in foreign countries. Okay, so you need to invest in foreign companies, means you have to go out of India, you have to buy foreign companies, you have to pay them in foreign currency. For this you need to borrow it from markets, and you have to repay them over time. Now you see, when you are taking money out of India and investing in foreign countries is what is capital flight outward. So when you are making an investment is good, but another point of discussion here is like people who are permanently moving out of India. You check this record, and you'll be very shocked to know that thousands and thousands of businessmen every year they are moving out of India to other developed nations permanently. They don't want to come back to India, and when they are moving out, they're taking their net worth, their wealth that they have created in India, which runs into billions and billions of dollars. Now, the USC country is at a loss when your own entrepreneurs are moving out of India along with your wealth. Is there are many reasons for it. One is like India is a very big country, population is huge, law and order issue is going to be very tough. Why? Because you see, you are having different religions in India, and sometimes you do have religious conflicts where may create disturbance. Unemployment is very high, and it is not only in India but outside also. But point is like you see, if you have don't have red carpet for your business community, so they will be getting motivated to go out to some other country where they are given much better treatment than what you're getting in local country. So you see, businessmen don't have any religion. I tell you, business don't have any religion. They simply move as per the profit or margin available to them. So if any other country is giving them a better opportunity, they'll be moving on. Like you see, Greece is a country in Europe which is giving good opportunity to Indian business houses. Canada is inviting farming community from India, especially from Punjab. So similarly, it is New Zealand, Australia, where they need manpower. They are bringing in specialized, skilled manpower from other countries to take the country forward. Now you see, this is how it is working. And now second term is there, which is like offshore banking unit. Now, an offshore banking unit is actually a bank which is located in an offshore location. Means you see, State Bank of India having their head office in Mumbai, opening a branch in India is onshore. Offshore is when they open up a branch in Dubai, or let's say they open a branch in Montreal, Canada. So offshore banking units are located usually in a foreign location. Especially there are some traits of it, like they do have low tax regime there. So taxation is not there. You go do business. When you do business, you make profit. You make profit. You have to pay tax to government. In India, it is 30%. So if any other country is offering 5% tax only or tax-free zone, they are allowing them 5 year or 10 year of no tax period. So you see, businessmen would like to enjoy this period and would like to move out. Why other countries are giving them free tax regime is because those countries don't have any employment opportunity. So when these business houses are moving to these foreign countries along with their family members permanently, means you're taking your capital along with you to these foreign countries, creating new business opportunities there and employment opportunities there. So you see, hence government is very, many countries are called as tax haven. So you see, you remit your money there, they don't ask you the source, they don't charge you anything on it. So you'd like to be very happy. You see, black money, take one example of black money. Or you see, there are so many shell companies, fake companies who are there in market, who are doing business just to avoid tax, just to avoid tax. Yani, you see, when you don't pay tax to government, so your income, which is actually, uh, you see, for you it is an income, but for government or for that jurisdiction, apex body, it may be, you see, something called as black money or income, which is unlawful income. Now you see, Hence, you see, when they move out to these countries which are far away, and they don't need any taxation requirement in their country, they don't ask you for the source of income. You see, there is no problem. You shift to these countries and you will never be asked for. You see, Vijay Mallya left India and presently is there in United Kingdom. Another person, Nirav Modi, fled India after this PNB bank scam, and he went to this country called as you see Antigua. Antigua is in West Indies. So you see, he left India. Why? Because these countries don't have strict laws in place. They don't have any, like you see, prisoner exchange policy within India. So you see, the people who are moving out of India, they know it very well where to go, which are the best alternatives available to them, uh, in order to in order to escape from your authority jurisdiction. Okay, now you see, the main reason for capital flight is because of the following: tax avoidance. Companies don't want to pay tax. If you compel them to pay tax on a higher rate, they
You have
get
5 minutes
motivation to
remaining.
move out. And then you see, political instability in country will again compel you to take your money out from this country to some other country where it is more secure. Wealth preservation is another important dimension why you would like to move it from here to some other country. The role, now we are going to discuss of offshore banking units, what they do. Banking, just now come back to normal banking. What bank do? Bank help you to remit money. You can send it to foreign country, you can get it from foreign country to India. Okay, so facilitating transfers, money transfer, okay, cross border transfers. So like, I'll give you one basic example. You must have heard about migrant laborers who are coming in from Bihar and other states of India to Punjab. Now what they do, they come in for a few months, let's say 5 to 6 months. When you do have work in Punjab, harvesting season is when they or flowing, any initial stage, you need migrant laborers. They'll come in, they'll work here, will stay here for 6 months, will accumulate all earnings and will move back to their home states, or they send those collected funds to their home states. Now this involves remittance. Okay, and second thing is, like, you see, these offshore banking units sometimes, when you are trying to avoid taxation, they don't give your details to anyone. Confidential data is not shared to anyone and everyone. So they kept your anonymity, yani they keep your identity confidential. And third is like regulatory arbitrage. If you are there in India, you have to follow income tax authority in India and Reserve Bank of India's direction. But when you go to foreign country, they may have different authorities. Now you see, wherever you find rules are a bit relaxed, you'll tend to move into those locations. So this is what is there. Next is, now what type of regulatory framework and oversight will be there for these offshore banking units. Now you see, you have to follow global standards. There is a term coming in, FATF, Financial Action Task Force. Now you see, money laundering is a major problem across the globe. So anti-money laundering is what is our goal. So we should not allow such practices. So hence there is a special committee which has been created at central level, and it is actually a mandate for every member nation. So all approximately 200 countries are member to this particular agreement. So they have to help uh, controlling this money laundering concept in their respective country. And because this is going to hit your state, because there are many terrorist activities which are done with this hawala funding. Okay, so if you have a transaction, you need to do it as per the set protocols. And you see, there is an agency who is taking care for bringing in global standards for every player, maybe from India, maybe from Pakistan or some other country. So when you have same standards everywhere, it's easy to map and identify. Next is like you see, domestic regulations. You have to follow domestic regulations. Finally, compliance challenges are there. So if you look all these things, these are related to your offshore banking units. So these are rules meant for companies who do have branches overseas. So they have to follow not only the local rules but also the global standard rules. Tax implications and reporting requirement. You see, when I'm an entity, a bank in India, and I'm having your account, I have to report your transactions to income tax authority if it is beyond a certain limit. Like any 10 lakh rupee transaction, which may be a withdrawal or maybe a deposit,